Revenue based financing. Revenue based financing is a type of financial capital provided to small or growing businesses in which investors inject capital into a business in return for fixed percentage of ongoing gross revenue, with payment increase and decreased based on business revenues, typically measured as monthly revenue. What is revenue based financing? In a revenue based financing investment, investors receives a regular share of the business income until predetermined amount has been paid. Typically, this predetermined amount is a multiple of the principal investment and usually ranges between 3 to 5 times to the original amount invested. What is an example of revenue financing? Revenue based financing in action. Let's say, for example, you have been loaned of a $50,000 on the condition that you pay back 10% of your monthly sales until the advance is repaid. With a variable collection, your repayments may look something like this: month one sale $30,000 mean you pay back $3,000 of the advance. What is revenue? Is revenue based financing a loan? Revenue based financing allows businesses to use their future business revenue to get financing from investors or financing firms. In alternative to debt or equity financing, revenue based loans can be good for startup businesses that don't qualify for financing through traditional means. What is the difference between venture debt and revenue based financing? Re-based financing is a much faster. The venture debt or equity financing sometimes as fast as 24 hours after applying, because it is dealing with smaller loan amount and is almost entirely based on your business sales and revenue history. What is the difference between finance and revenue? Finance accounting and reporting of income, cost, payroll, taxes. It is revenue, sales strategy, inventory management, daily analysis, long term planning and forecasting demand and revenue. So you can see the two department at very time. So there are many words as finance: AMC, Yahoo Finance, Atom Finance. Revenue based financing: non banking financial companies, financial advisor, financial consultant, magazine loan, Lido Finance, venture debt, best financial advisors, debt financing, financial planning, Yahoo Finance, Neo, Novavax, Yuha Finance, pre-financial advisors, and financial plannings are also goods. Let's see about this. Financial planning involves through evolution of one's money situation, income, spending, debt, and saving, and expectation for the future. It can be created independently or with the help of certified financial planner. What are the 5 steps of financial planning? Here are walkthrough of the 5 steps of the financial planning process. Step 1: understand your current financial situations. Step 2: write down your financial goals. Step 3: look at the different investment options. Step 4: create and implement customized plan for you. Step 5: re-evaluate, revise your plan. Now the what are the 7 components of financial plan? A good financial plan contains 7 key components: budgeting and taxes, managing liquidity or ready access cash, financing large purchase, managing your risk, investing your money, planning for retirement and the transfer of your wealth, communication and record keeping. So there are many types of other also financial based plannings. Let's look revenue based financing. So what is EBITDA in finance? EBITDA is an acronym for earning before interest, tax, depreciation, and amortization. EBITDA is a helpful formula for companies with long-term growth potential looking for investors, and it's also accurate way to compare one business to another. Revenue based financing is very good, and it's an non-dilutive from financing, which means that the company management retains complete independence and control, as there no equity investment or impact on the company shareholding. Usually the return to the investors continue until the initial capital amount plus a multiple, also known as cap, is repaid. Generally, investors expect the loan to be repaid within 1 to 5 years of the initial investment, depending on the model and the funded companies. RBF is often described as sitting between a bank loan typically requiring collectors significant assets and angel investment venture capitals.